Okay, well, good afternoon, and thank you for joining us for our session today, DSM Forward, Finding the Path Forward to Get Right Side Up When Your Business is Upside Down. We certainly appreciate your time today. This is part of our DSM Forward series presented by Greater Des Moines Partnership, and this is a part of our DSM Forward initiative, and the goal of that initiative is to help business leaders connect, share, and exchange ideas and information and resources related to moving forward into this next phase of reopening. Please know that the partnership has a lot of resources, including industry and business playbooks online and a robust lineup of programming that you can continue to tap into as we move throughout this journey. We have some great panelists here today, and we'll get to those folks in a moment. For now, I want to just welcome you, remind you that hopefully you are muted. If not, just please be sure that your microphone is muted, and go ahead and turn your camera off, except for our presenters. It saves bandwidth, and it actually helps us all kind of focus on that core presentation that they are all giving here, so I will do the same. And then just moving on to our panelists today. So again, the topic is finding your path forward. And these last 2 months have been just a whirlwind. And small businesses are some of the most resourceful and creative folks I know. But I also think there's a moment when you feel like you've exhausted all that and you need to just take a step back and really survey the landscape again and see where you're at with things. So what we have assembled today is essentially what we like to refer to as a personal board of directors. And we would always encourage small businesses to have those experts that they tap into. So your CPA, your banker, your attorney, and to not feel that you need to know everything about everything, and to tap into these folks throughout your business ownership journey. So we have today with us Jonathan Porter. He is with McGowen, Hurst, Clark & Smith, David Ling with Bankers Trust, and Drew Larson with BrownWinick. And what we're going to have each of them share are just some things to be thinking about right now, some things to look for within your own operations, and maybe some common challenges to mitigate, and then honestly just some candid conversation about where a lot of us are right now, and making sure that we can find that path out. And a lot of that right now has to do with financials and shoring up those types of things to make sure, you know, honestly, if we've gotten a little upside down in the last 70 days, 85 days, can I still get out of that and keep plugging forward? Or has this been so disruptive that I maybe need to start exploring other options? So I think it's important that we have that conversation today. So Jonathan is actually going to kick it off for us today. So Jonathan, I will let you go ahead and take it away. Thank you.
Okay.
Oh, you know what? And before I let you do that, please go ahead and use the chat function for questions. We'll take those at the end, but as they come to you, feel free to type those in. Apologies.
Cool. So hopefully everyone can see my screen. So I am the CPA point of view of this presentation. So I'll be talking more about the financial side, getting your financials right and stuff. So short disclaimer of, you know, make sure you reach out to a professional advisor about your own specific situations, because everyone is different. So just don't take my word for gold or anything like that. Make sure you reach out to somebody that knows your situation and you can talk through everything. So the most important thing is to make sure you do have accurate financials. I know probably a lot of businesses have in the past years been running their business based on gut feelings or just through their bank accounts. But now they might have hit a little snag, especially with COVID, that, you know, you don't quite know where you're at as a business until you kind of have your financials put together. So it's the most important thing to try and get that information into some sort of forms or financial statements that you'll be able to do some sort of analysis on. So the easiest way to kind of get that done is using some sort of accounting program. And if you do have one, make sure you are updating that as frequent as possible at this point. And if you do not have an accounting program, it might be a good time to decide, hey, is this the right moment for me to be making an investment into an accounting program? Like QuickBooks Online, Xero, FreshBooks are not a lot of upfront costs to kind of get going. It might be a little bit of a learning curve and stuff like that, but once you do use an accounting program, you will get a better classification of your information for the financial side of things. And then they do have nice built-in reports that will make it easier to do these analysis, now analyzing these financial statements like we'll be doing here in a little bit, and also be able to discuss further details with David or Drew about your specific situations. So, and if you do not have an accounting program, you're always free to use like an Excel spreadsheet or anything else to kind of classify them out and build out at least a profit and loss to kind of get an understanding. So on the screen, I just showed an example of a profit and loss. This is right from QuickBooks Online. So this is what similar financial statement you'll get from that program for the profit and loss. And here's the balance sheet. So the profit and loss is more of a snapshot for the year on your financial progress. And then, so you'll kind of have your net income where you're at as a business owner. Let me get the laser pointer out. And that's kind of your net income where you're at as a business owner. And then as your balance sheet, this is more of probably something a lot of small business owners don't look at a lot. So it'll kind of have your assets up top in regards to like your bank account, your fixed assets, or any other accounts receivable. Those type of items are all your assets. And then on the bottom side of it, your liabilities and equity section will have like your credit cards or any notes payables or car loan payments or anything like that. Liabilities will be in the liability section. Your equity section is about any money that you put in or took out of the business as an owner, and then also your net income. So if you're building out your own financials, this net income amount should tie back over from your profit and loss, so everything's kind of in balance. That's why it's called the balance sheet. And these two documents are going to be very important, especially if you go talk to the bank or to a lawyer, to kind of know where you're at as a business owner. And it's also very important to, if you're very uncomfortable or you have, even if you have these financials, but you're kind of unsure about those, reach out to a professional, an accountant or CPA, and they'll give you a good understanding of, hey, you should probably move some of these accounts around, or you don't quite have something classified right, because if you don't have this accurate, all these analysis that we'll be going through the next few slides, they're not going to be worth much. So it's good to have this as solid as possible at this point. And then I just want to show an example of a cash flow statement. These can be done multiple different ways, but this will strictly show you kind of your cash in for the beginning of the month, and then has all your cash coming in or out for the month, and then your ending cash for the month. So it will show your difference in cash, or what kind of happened for the month on your cash side of things. And I know for small businesses, cash is king usually. So this statement can be very powerful and useful to a business owner. And a lot of times this is just built in with QBO or another one of those accounting programs. If you're kind of doing this by hand, I have an Excel spreadsheet that I'll be showing later that you kind of put this together on your own to kind of get an understanding of where you are on the cash flow side of things. So now we'll talk about your financial analysis. So once you have the accurate financials, you can kind of do a break even. You can do a cash burn rate, and you can do a cash flow projection. We'll start with the break-even analysis. So this analysis is to help you get an understanding of how much revenue is needed to cover your fixed costs. So a couple of terminology things we'll need to go over. So variable costs are anything that increase with increasing sales. So direct labor or material. So if you were a manufacturing company and you're building widgets, those hard costs coming in for the materials to build those widgets are variable costs. And then anyone working on putting those parts together for the widget, those would be your variable cost also. So anytime your sales go up or down, probably, mostly up, those costs should be increasing at the same rate. And then the other item is your fixed costs. So these are costs that stay the same no matter what. And a lot of these are mainly considered like overhead costs. So rent, insurance, office expenses, supplies, stuff that doesn't really change day to day, or if your sales are 10,000 higher or lower from month to month. So that's kind of important to be able to classify your costs between those two buckets. So here's kind of how you do a break-even analysis by steps 1 through 5. In the next few slides, I'll be going over it with an example, so I'll kind of go into more detail at that point, so I'm not going to read that slide to you. But it is important to know down here at the bottom that if you do want to have like a potential to perform a deeper analysis on your break-even report, your analysis, you can include some cash transactions that are not on your profit and loss. So if you're paying yourself, or if you need to pay yourself an X amount of wage at the end of the month, or you always need to take home so much money, you always throw that in as a fixed cost, or any debt payments that you have, you throw those as fixed costs. So you can get an understanding of how much you need for sales figures in a period to cover all the cash transactions for your businesses. So this is a real simple profit and loss for a company. And basically your first step on a break-even is to classify your expenses as fixed or variable. So as you can see here, he has $100,000 of revenue. We'll just say this is for 1 month. You can do this over a certain, whatever time frame you want. You just got to realize that that would then qualify over to how much revenue you have over the same period. So this guy, we're going to say this is a month period. He has $100,000 of revenue. His cost of sales and direct labor are $30,000 and $10,000 for total cost of goods sold of $40,000. His normal operating costs or overhead is about $40,000, and then he has indirect labor, some administrative staff or whatever for $10,000. So then it comes $10,000. So basically, anything in this cost of goods bucket for this profit and loss is considered variable costs, because these will increase as his revenue increases. And these operating costs and these indirect labors are going to stay the same. So these are their fixed costs. So once you have those split up between variable and fixed, the next thing is to take your revenue and subtract out the variable cost to kind of get your gross profit. And so 100,000 minus the 40,000 gets you $60,000. And then you'll take your gross profit divided by your revenue, and now it kind of gives you gross profit margin. So this is a very, very important number for a lot of businesses. If your gross profit margin higher or lower than what you think it is, or if it changes quite a bit from month to month, this can really drastically affect your bottom line or how much cash you're getting into the company. So this would be something very important for all businesses to kind of keep track of as they go through their business life cycle. So the next step is once you figure out your gross profit margin, you'll take your total fixed cost divided by your gross profit, and that'll give you your break-even sales. So this guy will need $83,000 worth of sales to have his zero net income. So to basically keep his lights on, he needs to sell $83,000 worth of revenue. Again, as I said in the previous slide, if you wanted to make sure you had $5,000 to take home, and you had $2,000 of additional debt payments you need to get out of the business, you can always increase this number up, and you'll know exactly what you need for sales to kind of have everything flow through correctly on the cash side of things to be able to cover some of those additional costs that don't show up on the profit and loss. So that's kind of the break-even analysis. This is pretty powerful. It's pretty good for every business to kind of be looking at, especially this time frame. So this is just something you should consider doing. The next thing I'm going to be talking about is the burn rate. So this is a very, very, very high level analysis to get an understanding of how quickly you can burn through cash reserves. The reason I say it's very high level is because there's a lot of other different situations that could be happening on your financials that you're not capturing that might fluctuate this month to month. But if you just want a quick snapshot on kind of what you have for cash and what you have for cash reserves and how many months you have to kind of survive, this is a nice, easy thing you kind of do pretty quickly, because you don't really need financials to do this. So you can just log into your bank account and get a good understanding of how to do it, how to get this number. So we'll kind of take a look at that. So for this example, the business as of January 1st has $40,000 in his checking account. And at the end of March 31st, he has $22,000. So when you take $40,000 minus $22,000, they lost $18,000 in that 3-month period. So then the next step is to take how many months were in that calculation, which is 3, and divide 18 by 3, and you'll get 6. So basically what this is saying is that in 1 month, he'll burn $6,000 worth of cash. So if we look at it further, the guy has $26,000 worth of cash left in reserves, either in savings or he knows he can kind of get this in other ways outside of the business. He knows that his burn rate's $6,000 per month. He knows that he can last about 4.3 months with that current cash level that he has. So at that point, within the next 4 months, he needs to start making some other business decisions to kind of see what other ways he can, either stop his burn rates being so high or get a different influx of cash at that point. And the last kind of thing I want to show you is the cash flow projection. So this is just a quick analysis to kind of get understanding what your future cash will look like. Cash is king for most of the businesses, so it's important to kind of see what the flow will look like for the next year or 6 months or 3 months, whatever you're comfortable doing. And this could also point out some different points where an influx of cash from a bank or other investors will be needed at certain points. You can use Excel or spreadsheet programs to calculate this. There are third-party programs that can help. A couple of them are Fathom, Giraffe, Plain Guru, Float, and Pulse. A lot of those will connect into your accounting software and kind of make this process a little bit easier. There is an added cost to it, but I just want to throw those out there also, so you kind of know your options. So I'm not sure if you guys can see this very well, but I basically did an example of a 12-month cash flow projection for a business. And as you can see, his revenues and everything are going up month by month. But basically, this cash flow example kind of starts with your beginning cash for the month, and then kind of goes through your cash inputs, so your cash receipts from your business. It also includes any loan proceeds or owner contributions that you throw into the company. So they consider that all cash receipts, cash into the business. And you kind of look at the cash paid out. So this whole top part right here is all kind of related to your profit and loss. So you can kind of just throw that all, you can kind of get all the information from your financial statements. And then the next part's all kind of related to those cash items that do not hit your profit and loss. So any principal payments on your loans, any capital purchases that you plan on making, any other kind of startup costs or anything you need to take out of the business for your own paycheck or distributions. That's all get accounted for down here. And then you'll kind of know kind of what you have for cash at the end of the month. So this is a nice way for you kind of plan out for the next year and kind of see where or what point you're going to need some additional help. So as you can see for this business, a lot of this revenue side and his actual costs on the top here on the P&L are pretty consistent. He's probably be okay, but he knows that he's going to need some additional capital, some additional equipment or whatever to kind of keep the business growing at the rate it's currently going. And you can kind of see at the very end, at this current cash flow projection, that he's going to be short about $20,000. So at that point, he would need to know that, hey, maybe I should look at, instead of spending hard cash out on these capital purchases, maybe I need to reach out to a bank and see if I can get a loan to kind of spread this cost out, this cash output out over months or years, kind of ease some of the cash deficit or cash crunch that he's going to be facing at a later point. So this is just another good way to kind of look at your year, the future year, and kind of understanding where you're at as a business. So I went through that pretty quickly in regards to some of the analysis and some of the financial statements you need to be looking at. From my point of view, here's some checklist items that I would have you definitely try to consider or be looking at right now. So make sure you get your financials in order. You can't do anything without knowing where you are at. And even if you get your financials in order, it might be worth the money to spend a little bit of time to have professionals to look at to make sure everything looks correctly, so you can know that you're doing good analysis on your financials that are solid at that point. After you have good financials, I would definitely look at doing that break-even analysis to kind of get an understanding of, is your gross profit margin good? Are you able to make your sales, with your price points and quantity that you're going to be expecting to have in the next few months? If you're not going to be hitting your gross profit margin, what can you be doing? You can look at your product mix, kind of look at each individual product to see if your gross margin, see what their gross margin is, and focus on selling the high margin items. Or you can kind of decrease your variable costs if it's possible. So I don't know if anyone's been to like McDonald's, but they've really trimmed down their menu quite a bit recently. And it's more because of they're probably selling their most high margin items because they're probably unsure of how much foot traffic they'll be getting at that point. So they want to make sure every single sale that they do get, that it's going to be a high gross margin to be able to get put as much cash to the bottom line for them as possible. And then you can also examine your fixed costs to see if anything can be changed. Sometimes with the overhead that can be difficult, but it is an opportunity to kind of either cut down travel or anything, meals or entertainment, anything that you would normally be spending money on, try to decrease that as much as possible. And then also use a cash flow projection and get an idea of the big picture and what you'll be looking like months down the road. And once you kind of get that, and if you don't like what it looks like or will need some additional help, that's the point where you need to reach out to professionals like a banker to see if you can get any sort of cash relief, or you can just talk with the lawyer and see what the next steps are in your company's life cycle. So that's pretty much what I have from the CPA point of view. So I'll let Dave talk from the banker's point of view at this point.
Great. Thanks, Jonathan. Okay, I'm going to give this a try, share my screen. Okay, so yeah, a lot of my comments are really going to piggyback off of what Jonathan had to say. And I think maybe one thing to note, I think this is a great title for this conversation, Finding the Path Forward, because I think something that's unique about this global pandemic is it's affecting everybody in some way, shape, or form. So no matter what your business is, everybody's thinking through, what does this look like for me over the next 30, 60, 90 days, maybe even longer than that. And there's some bigger decisions to make. So kudos to you all for joining, and thanks for the partnership for putting this together. So I'm Dave Ling. I work for Bankers Trust and manage our business banking group. And so I was just asked to put together some thoughts around working with your bank, and really, working with your bank in some uncertain times. I think maybe people are a little more hesitant to call their banker. They're pretty quick to call their CPA or their attorney. But when it comes to their bank, especially if there's a loan in consideration, I think maybe sometimes people are a little more hesitant on what they need to be. So working with your bank, here's 4 things, and we'll dig into each of these, but know your reality. Communication is essential. Be open and honest, and then we'll wrap up and talk about some things you can expect in return from your bank. So knowing your reality, actually, Jonathan, that's a great segue into this slide, because when we talk about knowing your reality, it really is coming back to the financial matters of your business, because those are the things that are really going to help you determine what's viable moving forward and what's not. So, and if you do some of those things that Jonathan was mentioning, I say here, dig into the details and be current. You'll do that because you'll know what's impacting your business. It's not just, well, my revenues are down, or I'm not making money, or I don't have cash in my account. You're going to understand what's impacting that. And over the last several months here, it could be just simply your business has not been open. Or even if you have been, maybe you haven't been able to purchase the inventory that you normally would. Maybe you haven't been able to maintain the sales staff that you typically do. Those are all things that mean something different when you're working out a plan with your banker, and will be helpful. And Jonathan covered this too. Make lists of your fixed and variable costs and prioritize those most crucial to your business to help you make decisions. Because once you can, sometimes it's even just as easy as putting them on paper so you can see them. And then that's going to be a place where you can look and you'll figure out if you have some levers that you can pull there. Reiterating the impact to your customers. I thought that was worth a bullet point on its own, because that's something that your banker will likely ask you. Understanding what's impacting your business is very important. But as you're starting to consider opening your doors back up or ramping your business back up, what's been the impact of this environment to your customers, and how is that going to affect you going forward? That's just a really important thing to think about. So, in looking at different cash flow scenarios, determine how long you can sustain operations despite impacts to your revenue. Again, I put in parentheses down here, best case, worst case, and most likely case. Really what we're saying here, this is kind of how the bank looks at it. So best case would be how optimistic, the kind of your most optimistic outlook. Similarly, worst case, what's your worst possible outlook? And then your most likely, your business better than anybody else. And so having best case, a worst case, and then your most likely really just gives you some parameters to work with and figure out, what's it going to look like over the next 30, 60, 90 days, year, 2 years, 3 years. And it's going to give you some benchmarks there. I also would really encourage you, if there's a loan in consideration, review your loan documents and agreements before you call your banker. This is more just to, take any surprises away from you. What are your current terms with your loan? When's the loan going to mature? If hopefully that is sometime down the road, hopefully that didn't happen, a month ago. But knowing what your maturity date is, what secures your loan, sometimes, most cases, and most of the time, it's your business assets that is part of your loan agreement that the bank has taken collateral on. But sometimes there's other assets that come into play depending on what that loan required initially. It could have been, sometimes it's home equity and there's a mortgage that's out there. Sometimes it's investable assets and there's a pledge on some cash somewhere else. So just reminding yourself what's in play with your loan is going to help you make a decision on how you want to move forward. Similarly with personal guarantees, most of the time personal guarantees are required with small business loans. So just having that in the back of your mind and understanding what that means and talking to your banker about that when the time comes, again, will be something that'll help you make some decisions. Communication is important, but timely communication is essential. Honestly, with this topic, I probably could have just left it right here and just given this one slide to you to consider. You don't want to wait for kind of the worst case scenario to happen before you call your bank or your banker. And I put up there bank or banker, because if you don't know who your banker is, that's probably a good place to start and just reach out to your bank. There will be an account officer that's tied to your deposit accounts or your business loan. And so just calling and saying, I'm trying to figure out who my point of contact is, your bank can point you in the right direction. But don't wait until a payment is past due, or don't wait until your loan has matured. Just reach out to your banker before that happens. There are options, but you just have to give yourself some time, you and your banker some time to consider them. So some of those options that you would likely be talking through would be restructuring your loan. And again, having some of those financial models laid out, similar to what Jonathan was speaking to. What happens if you take your loan from 3 years to 5 years and you stretch those payments out a little bit further, or even 5 years to 7 years? How much cash flow relief is that going to give you? And does that help you make a better decision or a different decision? Similarly, payment modifications, these are all any way that you would modify your payment. You would be, ideally giving yourself some cash flow relief. And these are all options that your bank would entertain with you. So lowering your interest rate, converting your payments from principal and interest to just interest only, that could be helpful. and in some cases, putting your payment on deferment, full deferment for a couple months, that might even be an option. But considering those things early are going to give you the most possibilities. And then loan maturity extensions. If you're at a place where you have a line of credit or a loan that's coming due and you're not quite at the place where you're ready to commit to another 12 months, 24 months, whatever, maybe what you want to talk to your bank about is, can we just take that maturity and push it out 90 days so we can all get a better understanding of what our reality is, and we can make a better decision at that time. So that's fairly common and something that your bank, I'm sure, would work with you on. So the other question I put up here is just think through what you need. Your banker's there to help kind of manage through that. But if you can come to some conclusions on your own before you have that phone call, and say, going to your banker and saying, hey, if I can push my payments out a couple more years, I think that's going to give me the relief that I need. That's going to be a good place to start. And really you're asking yourself a couple questions here when it comes to your business, and especially if there's a loan involved. Can you manage with some payment relief, or regardless of payment relief, you feel like there might be some insurmountable headwinds, and what is that going to look like? So those are two big things just to kind of be thinking through before you have that call with your banker, so that you can just have a really open and honest conversation. And speaking of that, be open and honest is really important. So your bank really, there's incentive there for them to work through your current situation, and banks have policies and procedures around this. So if your business is running into some headwinds, it's not going to be the first time that you call your banker and they're hearing, hey, things aren't going the way that I thought that they would right now. And certainly, in the middle of a global pandemic, this is not going to be something that they haven't heard or have been thinking through already. So just be open and honest and start working on a plan, and it's kind of redundant, but to have a plan, you have to have a plan, and I think when you're putting when all of you started your businesses, without a doubt, you had a really robust business plan. And I'm guessing that business plan didn't include the possibility of a global pandemic. So now is the time to go back and revisit that plan. And you're not looking to make a plan for the next 24 months, 3 years, 5 years. You're looking to put a plan in place for the next, maybe it's 30 days or 60 days, 90 days. And, so you're really scaling that back in and getting focused on the short term and what needs to happen. And I think starting to kind of formalize that plan is going to be helpful when you speak with your banker. And again, be open and honest in that. The conversation is, here's my reality. This is what I'm looking at. And I put in parentheses that most likely scenario. This is really what I'm banking on. It could go this way or it could go that way, but this is really what I'm thinking. And can you help me from the bank's perspective to think this through a little bit more? And again, just to reiterate, think what you need from your bank. And your banker's going to have input. Again, there's policies and procedures in place that they have when you make that phone call. But just think through in your mind what you need. Again, if you can put a payment on interest only, what is that going to do to you? If you can stretch out your payments a little bit longer, how is that going to help? And just having some thoughts there. And if you do those things and have those conversations, and you agree on a path forward with your bank, here's some things that you could expect from them that, hopefully wouldn't come as a surprise. But maybe, again, think about if you hadn't spoken to your banker or didn't know who your banker was until you make this phone call and inquire, chances are you're going to have that conversation and your banker is going to say, okay, now we're on the same page and let's stay up to date. We're going to have more scheduled communication. So maybe we're going to going to speak at least monthly, and we're just going to check in. Are things going the way that you thought that they would? And if not, what do we need to be doing? Additional or increased reporting, it's really good. Those statements that Jonathan, Jonathan was mentioning, you've got to have that data, some of that data, to be able to analyze and make a decision. And similarly with your bank, they're going to be looking for some kind of data to help make that plan to move forward. So they may require, if you haven't had any financial reporting prior to now, if you're figuring out a way to work through a loan, in this time of disruption, they're probably going to ask for some type of reporting from you. So financial income statement, balance sheet, maybe it's just that cash flow projection, something in Excel, just something that says we're tracking and we know where we're at on a current basis. They may even suggest putting in some financial benchmarks. So if you put a plan in place, and whatever kind of reporting that you're using to analyze your current situation, okay, that's what we're going to use today. And then we're going to measure against that in 30 days and then in another 30 days, just so there's the ability to track progress and keep everybody on the same page. So that's really for this part, that's really what I've had prepared for you. If you have questions, there's some contact information. One thing, probably again, if I could go back and reiterate one thing, is that timely communication is essential. Don't feel like if you call your bank and say, hey, I'm running into some roadblocks here and I need to pivot and I need to think this through, they're going to appreciate that conversation before a payment goes past due and they're trying to call you, or before a loan's matured and now they're trying to call you. If you can, your business, what challenges are lying ahead when it comes to some of these topics. And so you being proactive and reaching out to your banker is going to certainly allow for the most flexibility. And that's not certainly admitting, any sort of defeat or failure. That's just you being a prudent business owner and reaching out to your industry partner and saying, hey, I need to pivot and I need to put a plan in place and I need your help doing it. So that would be my, maybe my leaving remarks here and encouragement. So, but that's what I got for you. So we'll move on to Drew with BrownWinick next. We can figure out how to stop my screen share there.
Yep, I got it here. Thank you, Dave. And we'll get the presentation popped up here. There we go. Can everyone see the presentation? Looks like it. Thumbs up from Dave and Jonathan will do the trick. All right, I see thumbs up. Victory. So again, as I mentioned, my name is Drew Larson. I'm a partner and attorney at BrownWinick. And this is a topic that's near and dear to my heart. I was also a small business owner. I bought a manufacturing business with my father, and we actually went through this process. We were not able to make it work. We had it for about 5 years. But I was on the borrower side of a loan, where we had a number of years where things were up and down and all around. And I had a really good relationship with my banker. And while it didn't end up working out, that process went as well as could be expected, and I still have a good relationship with that person. And I think everyone ended up better off by virtue of that cooperation and communication. So I can't reiterate enough what Dave was saying is call early and call often. Your banker is, they're invested in your business, right? They have a lot in it just like you do. And you all want to see it succeed and minimize any losses. So we're talking about the path forward. I also have that standard disclaimer. I joke that it basically says you shouldn't listen to anything I say, and then I proceed to tell you stuff that I think you should listen to. But as Jonathan mentioned, facts matter, and your specific facts are going to be important. You'll notice we had our tagline, be bold and be wise. And I always joke that wisdom, knowledge is what you actually know and thinking about what you know. Wisdom is knowing what you don't know. I think wisdom is probably the most important thing in this whole process. We are living in a world of uncertainty. If your business is struggling, we don't know. This is true for our law firm. It's true for my manufacturing business and probably any of you. We don't know what 3 months from now looks like. If things open up, we don't know if people are going to stay home. Does that mean you'll be at 25% capacity as a restaurant or 75%? And that'll be meaningful. So what you're often trying to do is get the best result you can, make a best prediction you can, and then verify and try to figure out if those predictions are going to work. The great irony here is that the people you want to talk to first were in the right order. You want to talk to your accountant and your banker first, right? They are the most important people to talk to. What is your lawyer going to do? We're going to talk to you a little bit about what your options are and maybe help you weigh some of that uncertainty and understand the consequences of making some of these choices back and forth. What my goal is today is to give you some general information about sort of what happens if things aren't going well, or if you have to close, and then we'll talk a little more details about making those decisions. So the first thing I wanted to say is, if your business is in a position where you actually are going to have to close down, or you're worried about that, it's important to understand the basic ways in which, what happens with what's left over. You have some, I'll use a restaurant as an example. You've got your restaurant, maybe you've got the equipment, the kitchen stuff, the tables, the chairs, all the stuff that clearly, you use to manage and operate your business. What happens to all of that stuff? Well, as Dave mentioned, the first person to get assets are secured creditors. And if you're a business, almost assuredly, you have given a security interest, which is a mortgage or a lien, on all of your business assets. Like, that is standard. It'd be an exception, or you must be really well collateralized to not be in that position. If there happens to be something left over after your assets are sold and liquidated, so we sell the ovens and the furniture and whatnot, after the secured creditors get paid, then we go to unsecured creditors. That would be employees, standard vendors. So maybe my food vendor doesn't have a security interest. People like that. The newspaper, if I promise to buy ads every month, but I'm not doing that now, those would be your unsecured creditors. And then, yes, you as the business owner are the last in the list, right? Now, if you're also an employee, that salary may be a part of that unsecured credit. But generally speaking, you and your equity and your investment in the business is the last thing to get paid back. The next question to ask, and this is about looking at those loan documents that Dave mentioned, is who's liable for a business's debts? Assuming you've set up an entity, which generally speaking you'd have been recommended to do. Generally, the owner is not personally responsible for the debts of a business entity. The big exception, and one that will matter a lot, is basically every small business loan will require a personal guarantee. The SBA absolutely requires it for any loan from any owner that owns 20% or more of the business. But it's standard. So most likely that secured creditor group is also going to have a personal guarantee. And they may have that secured, as David mentioned, by like a mortgage or second mortgage on your home, or if you happen to have other valuable assets, or maybe a rental real estate or something like that, but something where there's some collateral to support the repayment of those debts. We talked a little bit, again, the secured creditors, those are people that have collateral supporting and ensuring they're going to get paid. Unsecured creditors are the ones who are they're relying on trust in your ongoing business to cover that, and they have no collateral supporting their debts. So who are those secured creditors? Already mentioned, it's banks and credit unions. Those are the most common. Occasionally there'll be someone else, maybe you bought your business from someone and they may have some security if they finance part of that purchase. And again, what is the collateral they generally have? It's your real estate. That tends to be the largest. And in some ways, it's the best collateral for the bank. It can't move. You can't hide your real estate. You can't pick it up, put it in a truck, hide it under a tarp, right? Like, it's there and they know where it is. Equipment, inventory, supplies, things like that. And then also some of the things that you may not think about, but your accounts receivable. So the amounts of cash that maybe third parties owe you, if you sold it on credit, stuff like that, that's often collateral as well. Your unsecured creditors, as I mentioned, your employees, most suppliers and vendors, they don't have any claims collateral and they get what's left over. Again, generally, that's not very much. If your business really is struggling and is likely in is closing, usually the secured creditors have more debt than they're going to get covered by the collateral, at least the business collateral. Personal guarantees, this is the thing that is hardest. I have no problem. I think it's completely reasonable for the banks to want these, and they're making often your dreams possible early on. But it's important to recognize that when you're thinking about what is going to happen and the consequences of either your business not working or making a decision to close it down, understanding who has personal guarantees and what that means for you is really important. So What is it? It's just a commitment by you as an individual or potentially some other third party to cover the debts of a business. It's generally the owners. It's often secured by those mortgages on your home or other real estate. It's important to note that if you have a personal guarantee, but there's no mortgage on your homestead, the home you actually live in, generally speaking, that home is exempt from creditors absent one of those mortgages. So it's one of those things you're going to want to think about. What is the scope of my personal risk? How much of that debt am I going to be paid off? How much of that am I going to have to cover on the personal side, or will I potentially be on the hook for? I am a hopeful person. I realize some of the discussion so far on my end has been maybe seems less than hopeful, but there are options to stay open, and you can work towards those. And I encourage people to think real hard about what they can do. Already mentioned, but the first thing you're going to think about is, are there ways to reduce costs? You've probably heard the saying, fire fast and hire slow. That sounds really terrible, and it doesn't necessarily pull at my like Midwestern, like do right by people sort of roots. But you'll find when you are in tough financial straits and your business future is potentially on the line, you often have to make hard decisions about some of those costs earlier. And the earlier you do it, you often are preserving long-term the likelihood that you'll be able to keep the business open and keep some jobs open in the long term. I've had to do those layoffs personally. It is very, very hard. I always joked, it's easy to fire the jerk who is highly destructive at your business. It's really, really hard to fire the person you really like, who's done a good job, but you just can't afford to keep them on. Those are some of the worst days of my professional career, is those conversations. But we did it because we had 10 employees and we had to lay off 2 to save 8. And if we didn't, I'm pretty sure we'd have laid off 10 much quicker. So you may have to make those kind of hard decisions in the near term and think about those kinds of things. If there's other costs, talking to your bank about potential payment modification to conserve that cash so you can buy the time to see how this uncertainty plays out, whether some of the assumptions or hopes about how things turn around will happen. You know, even salary reductions, you know, if everyone can take a little bit, sharing in that pain. Again, the lawyer will say this, but trying to work with your vendors to maybe spread out some payments. Of course, if you call them about that, they're going to get much less likely to deliver you new stuff if you're not willing to pay for the stuff you already have. But think about the people you can work with on those kinds of things. Again, acting sooner rather than later is really critical. That's hard to say, it's hard to do, but I do believe in the long run, it tends to be best for almost everyone, and you're trying to make something work. One of the questions I'll always say is, one, financing, you should not assume it's going to be available, but it's possible that you might be able to find some additional financing. And if it's not from like a professional, like a bank, you may want to borrow from a parent or a relative or, Uncle Larry, whoever it happens to be. If you're going to think about that financing, you are asking that person to make an investment in this business. And if you don't have confidence that it's going to work, you need to think really hard about whether you want that person to do that and whether you'll be able to be a good steward for those funds. And the reality is, it ties back to what Jonathan was saying. Where were you before the pandemic, right? That's one of the questions I'm going to ask, and it's not a fun one, but if things were not great before the pandemic, do you believe they're going to be great afterwards? If you borrow more and increase your fixed costs, do we have reason to believe that after this resolves itself, and who knows how long that will be, that you're going to be in a better position to pay off this extra debt or extra obligations? Are you going to have to commit to way more or put way more of your assets and personal financial recovery, your safety net, so to speak, at risk than you would have otherwise? So one of the things might be adding a personal guarantee, pledging personal capital or a collateral, maybe a vehicle, or again, a second mortgage on your home if you hadn't already, those kinds of things. You should think really carefully about how strongly you feel about the business's long-term prospects before you add a whole bunch of personal risk to the equation. That isn't to say that we want to stiff anybody. It's not to say that you should throw in the towel easily, but you should at least be considering whether you are going to risk your entire personal safety net, or how much you're willing to add to that risk, maybe than you already face, before making any decision about how you move forward. Options for closing. Again, no one wants to be in this position. It was, speaking of hard decisions with me and my father, I bought my business with my father. Yeah, that was super difficult. And those are some of the hardest and saddest conversations I've had with him as well. And but we had it when we decided we couldn't continue. The first person we called was our bank, was to have that conversation. So like most of the time, they had a security interest, or they had collateral interest in all of our business assets. My father had a personal guarantee, and there was a second mortgage on his house. So it was an SBA loan, a very common sort of structure for these kinds of things. We made that call, and once we figured out, and we'd given it our all, and we'd worked with the bank, and we'd tried everything they'd suggested and all those things, when we also decided it wasn't going to work, or it was time to be done, we started to have the conversation, how do we wind this down the most effectively we can? The goal often is to minimize costs and get the best possible value for all of your assets and collateral, to pay down as much of that debt as you can. Hopefully you can pay down the whole thing, but if you can't, you can't, and you try to do the best you can. That conversation can be done. Often the bank will have people they work with to help you do that. But in our case, for example, we ended up finding 6 buyers for the real estate and got an excellent price, about 30% higher than we sort of expected, because we were willing to put in some effort and limit that exposure for my father going forward. So having that conversation with the bank, that doesn't mean you're going to get to control the process. You have a partner in this now, but having the conversation and trying to find ways to maximize that value both builds goodwill, which will be handy as you're dealing with your personal guarantees. But also just it pays off as much of the debt as possible, and that's a good place to be. When it comes to the personal guarantees, obviously there's only so much you can do. You can't just say, please don't collect on that, and someone's going to walk away, right? It was part of the deal. It's not unfair for someone to want to collect against that. But often if you can put in the work and you are cooperative, you can find ways to maybe refinance part of that, or find ways to work with your creditor or otherwise to get a sort of a win-win situation. Because collecting against you or foreclosing on a house, for example, is a miserable experience. It's costly, it drives the value down, generally is bad for everyone. So there's often room to negotiate win-wins, and it's easier to get a reasonable deal and something that works for everyone when you have a good relationship with the other side. If things really do go poorly and you can't negotiate those sales completely, which again is not uncommon, or you might even negotiate for this, the process in which a creditor, any creditor, takes action against you is they get a judgment, they file some sort of claim or action with the court, they get a judgment, that's an order from the court saying you do owe it. And then generally they're able to repossess collateral if they do have collateral and sell those in a commercially reasonable manner to help satisfy those debts. Often the secured creditor, not only while they're going on those judgments, they'll also get the judgment on the personal guarantee and be able to take steps to collect against that as well. That may include garnishment in the long term on any future wages, stuff like that. Judgments can last a very long time. We've had some clients where there was some real estate, or they were thinking about buying real estate, and the person had just sort of skipped on us and didn't have any liquid assets we could easily collect against. But we had a lien against the real estate, and 8 years later, we got a call out of the blue that they were selling it, and we were there on the records, and they had to pay us off to do it. So some of those can last a long time. Invariably, if you're closing a business, you have thought about you've heard the term bankruptcy. No, it is not like The Office. You don't just get to yell bankruptcy like Michael Scott and like that somehow magically does something. Of course, it's one of my favorite episodes. I can't help myself with The Office. But what is bankruptcy? So there's a feeling people will often in shorthand say, hey, I'm bankrupt. Well, bankruptcy really is a formal legal experience and process. Being insolvent, meaning you can't pay all your bills, does not mean you filed for bankruptcy or that you're bankrupt. But what it is, if you find yourself in that situation, is you can file for what's called bankruptcy protection. And what it is it's a court-managed process to try to give people a fresh start. That does not mean it's costless. Obviously, it destroys credit and does a lot of other things. But what it does is the court, through a disclosure system, you gather all of the assets that you have, whether it's your business filing. If it's a business filing of bankruptcy, what are all the assets, like on that balance sheet, for example? If it's you personally, you do something similar. What are all of your assets? And then what are all of your liabilities? And the court goes through the process of allocating your assets that are non-exempt to those creditors in the order of their priority. So secured creditors get the value of their security, unsecured then split on a proportionate basis, anything that's left over. And then after a bankruptcy, you're what is called, you get a discharge. And basically any prior existing debts are no longer effective against you and can't be collected against. So what I would say is often people ask, should my business file for bankruptcy? And I'll be the first to say I do not do a ton of bankruptcy. I advise clients who are struggling, but I'm not a bankruptcy attorney, and there's much nuance in the process in that. But generally speaking, for a small business that is not succeeding, bankruptcy is really useful if you want to restructure and continue to operate the business. It can be complex, it can be expensive, but often you'll read about it in the news, and it's someone who has, hundreds of millions of debt. We'll just say it was like, I don't want to use it. Let's just say it was a national restaurant chain that had plenty of debt, they were paying it, and now all of a sudden it's a disaster because they're all closed. Bankruptcy may be a process for them to sort of force through the court process to negotiate with those creditors to extend out terms, change sort of the structure to deal with this, so that they can come out on the other side with sort of a set of creditors and a financing arrangement that is sustainable, sort of like that cash flow analysis. Generally speaking, it's not very useful for small businesses. So you're not going to find many people who do it because it doesn't get them much. That's not the likely outcome. There's not enough assets or business to think that they're going to survive. On the personal side, it is more common and more valuable for a small business owner. So your business closes, there's leftovers, the sale of the assets does not cover all the debt. You have a personal guarantee. A personal bankruptcy is at least something that you may consider to try to basically resolve and sort of fix or discharge anything excess. So for example, let's just say you've had most of your savings in your business, not an uncommon position for a small business owner, and after everything's done, there's still $1 million owed to creditors that you're stuck in a personal guarantee, and there's sort of no way you're going to be able to pay that out of your current stuff. A personal bankruptcy to eliminate that, pay what you can out of those non-exempt assets. The courts will then grant you the protection. You're giving up something. You should know the consequences of that, like on the credit score and things like that. But those tend to be the circumstances where it makes the most sense. Meeting with your attorney. So again, I'd meet with your accountant and your banker first. Ultimately, you're going to get more value out of that. But if you do go talk to your attorney, it's not a terrible idea. I'd like to think we add some value and give you some context. But bring that information in numbers. We can't help you evaluate alternatives and think about sort of risks unless we actually understand your situation. And that includes both the business's financial information and your personal financial situation. We need to understand what those personal guarantees are, what your personal collateral is, and whatnot. Bring those formal loan documents and other information. Be ready to have a hard and frank conversation. You're in for a long run here. Be ready to ask yourself those hard questions and be honest with yourself about what those answers are, because you'll be better off by having that upfront rather than later. And then ask your attorney about exemptions and potential outcomes. Exemptions are certain assets that are sort of necessary for survival that the law says that can't be collected against by creditors, sort of to ensure that you have enough going for you that you can, basically survive and potentially get back on your feet. General thoughts on this. The numbers are, well, it's not necessarily easy to prepare them. They are easier to deal with and understand than the emotion. The emotion is really hard. There's no easy answer. You're going to lay awake at bed at night. I will tell you that it gets a bit harder if a business is not going well and you decide to close, but it does get easier. I find it takes 6 months. That was both our experience and many of my clients, where after you're sort of done and have gone through that, it takes about 6 months to sort of be like, oh yeah, it's over now. And I'm moving on, and I figured out, I can see, you can picture in your mind's eye what the future looks like for you. This last one, I will occasionally run into people who've done this. Do not take the business equivalent of payday loans. So for whatever, I don't know how they figure it out, but when a business starts struggling, they'll start getting these calls from, they'll be called something capital. I hate to say it, it always feels like they come out of like New Jersey. But it's basically like, oh, here, we'll give you this loan and we're gonna take 5% of your sales and they all have to be deposited into our bank account. And like the effective interest rate's like 40%, but we'll help you get through this tough time. I'll guarantee you if you take those loans, you're just digging a hole that maybe you can't get out of, you're just digging it much deeper. If you are at the point where you're thinking about taking those loans, it's probably time to think real seriously about being done. I don't know how they find people, but they do, and you will get plenty of those calls potentially if you're struggling. I can't think of a single circumstance where I thought it's been the right decision. The same with racking up like $20,000 on your credit card. Like that's a bad plan for the most part. So you tend to make the inevitable much worse at that point. So I realize that was a broad brushstroke, lots of different stuff, but I think we do have a little time for questions, hopefully.
We do, so feel free to go and type those into the chat. In the meantime, I want to just offer my thanks for sharing that guidance. And Drew, it's interesting that you bring up those loans. We actually had been working with a business who took that as a quick solution, and to unravel that and get out of that sort of payday loan type of situation for a business is virtually impossible. And it's going to end up what sinks the ship after all that, which is just frustrating and terrifying. So I appreciate you mentioning that. Do know that this session is recorded. We will post it in the next few days. There's a lot of good resources here that Dave and Drew and Jonathan have shared, so thank you. Also in the chat, I'm going to push out some additional websites that you can visit. I want to back up and say that we always encourage you to have your personal board of directors. So if you look at the panel we have here today, make sure that if you don't know who your banker technically is, that's okay. Reach out and find that person today and start and build that relationship. If you don't have a CPA, I encourage you to find one. Same with an attorney. But also know that the Iowa Small Business Development Center is a great place to start as well. And the Women's Business Center, they offer free counseling for businesses and can start talking you through some of these scenarios as well and give you a quick overview of financials. And then they can also send you off for additional professional assistance. But it's a great, easy place to start for those of you that have made it this far in this crazy journey. And we want you to be finding that right path forward and that right answer for you. So with that, I think we will wrap up today. We are at time, and if you have questions that come to you later, feel free to reach out to us at the partnership. And if we don't have the answer, we will find someone that does. In the meantime, take care, and thank you all for your participation today.